Hello and welcome. Welcome again to a special series that we are hosting on Stockal, and for the benefit of all those investors who are looking at the US markets. The dizzying way in which the markets have rebounded from that low on March 23rd, and then the kind of returns it has given over the last 3 months or so. It's been spectacular, nothing short of spectacular, the way the markets have moved up. So it's time to learn something about how you can invest in the US markets. What are some of the things that you need to keep in mind? What are some of those ideas that you need to focus on? What are some of those ways? And what are the gurus telling you? What are the experts telling you? How can you go about it? In India, the liberalized remittance scheme, or the LRS, from the Reserve Bank allows Indians to invest up to $250,000 in the US markets. And of course, there are a variety of investments for which they can use that money, up to $250,000. But the important thing is it also includes investing in the equity markets there, among the other options that there are. So we'll be talking about it, and we'll have our experts who will be joining us very soon. And the experts will be here, a very seasoned bunch of people. We'll have two very special people joining us, people who have experience in the markets and who've had a long experience in the markets. John Rees, founder and CEO of Validia, excuse me. I still am to get that name right. So John Rees, founder and CEO of Validia. I really love that name, that company, the way he said it's a validation of an idea as he explained it to me. So Validia CEO and founder John Rees will be with us, and M.I. Tahir, he is head of the MENA region at Stockal. And before this, he has helped establish several joint ventures, very blue chip joint ventures in the Middle East. So they will be telling you what all you need to keep an eye on, what all you need to track so that you can invest in the US markets. So we'll be talking about that, and we're waiting for John to join us there. John and Tahira here. Thank you so much, gentlemen, for joining us. Thank you for taking out the time for this very, very special occasion where we are trying to tell people how they should be going. Let me do the formal introductions so that everyone knows who they are speaking to and why they need to be very particular, listen to every word very carefully, and so that there is a lot to take away. First, from the US joining us is John Rees, founder and CEO of Validia, and he's the co-author of the investing book, The Guru Investor, How to Beat the Market Using History's Best Investment Strategies. And you'd love to listen to him. We also have M.I. Tahir. He's head of MENA region at Stockal, that is Middle East and North Africa, and he's leading Stockal's foray into the region. Before this, as I mentioned earlier, he has helped establish 3 blue chip ventures, for different ventures, of course, in the Middle East region. So we'll start with John, and I'll request him to first give a big picture view, and of course tell a little bit more, if you'd like, John, about your experience in the markets and how today it's an opportunity that investors in India, in the Middle East and North African region can make use of by investing in the American markets.
I'll share a little bit more about my background. I have degrees in computers and electronics from MIT, MBA at Harvard Business School, but my interest in the stock market started way back at MIT when I worked for its artificial intelligence laboratory. And my goal and assignment there was to take knowledge and wisdom from books and translate that into computer programs. And I would then come back to that maybe 25 years later when I had sold my company, was looking how to invest my own money. And I started reading about 200 different books and maybe 50 periodicals a month. And I finally came across one book, Peter Lynch's One Up on Wall Street, where I was able to take the wisdom of Peter Lynch, put it into computer code, and then apply that to stocks in the market. Then I started sharing the information of that on the internet. That became a newsletter subscription service. Then it became a capital management firm. So I've been doing this for about 25 years now, starting with the artificial intelligence and the theme of taking the wisdom of books and other academic papers and computerizing it. So what's interesting for why is the US market particularly attractive is that, number one, it represents obviously diversification for the market. The second is that it's actually, let me share an interesting slide with you. Hang on just one second. Let me pull it. Oh, actually, I'm showing, you need to re-enable the screen sharing. I think I'm coming in as a participant rather than the...
we'll just have that organized in just a few seconds.
Sure.
While you're trying to do that. Hopefully it should be done by now. And
yes. So some interesting points about the U.S. market is that it represents $21 million in annual GDP. And I want to put that in the context of, here's a map of the United States. If we take, for instance, India's entire economy, that would fit within the state of California, one of 50 states. UAE fits in one of our middle states. Saudi Arabia fits in one of our states. So you see that the U.S. economy that we're investing in, that's available, is absolutely huge compared to the combination of the rest of the world. In fact, it actually represents 54%. So of the total stock market values of all stocks around the world. So if an investor is missing it or doesn't include it in a portfolio, they're missing 54% of the world's economy. But the other key things, besides access to a big market, is there are currency benefits. The trends over the last 10 years for the Indian rupee per se compared to the United States, you benefit just by being holding United States currency. There are liquidity advantages. Almost all the stocks that we trade are extremely easy to buy and sell at almost any time. And there's higher shareholder yield in terms of dividends and buyback than go on in most parts of the world, and certain structural edges. This is subtle and difficult to appreciate, but there's a huge amount of quality and data available on each of these companies. And the data itself is very, very high quality. When we try to translate to other markets, we find an extreme amount of work to clean up the data sets that the companies are actually supplying. And there's a lot more regulation in the US market that 99.9% of the companies adhere to. They keep it clean and easy to trade, and again, believable information. So those are a number of the key reasons to invest in the US market and what makes it attractive.
Very interesting that you've made this point on why it is so important to invest in the US markets. Also the hub of new ideas, because way ahead of its time, you see several new ideas crop up, whether they are themed, whether they're individual ideas, they crop up. How important is it for investors to latch on to some of these early enough?
It's very important, and I'll share another little slide with you. For the United States, you have a number, most of the world's leading companies, whether it's Apple, Microsoft, Facebook, Netflix, Amazon, Google. But what's happening is, why do these companies happen and spin off? You have some of the world's tremendous leading university, Harvard, MIT, Yale, Stanford, that have cultures around. When I was at MIT almost 50 years ago at this particular point, venture capital to enable people to found their business was a very important part of the culture there, even at that time. There was this infrastructure to allow people who had these extra technical ideas or even consumer ideas to be backed with support by leading venture capitalists. So it is very important to latch on to particular ideas, but I will share this. What Peter Lynch found is that even these companies, call it in the very first inning, using a baseball analogy, is that there are still many more innings to grow. Once they latch on and start to show traction, the stock market returns are still available for them in later innings. So yes, it's good to recognize early companies. And again, I want to specify that there are a huge number of early companies in the United States latch onto. But even at the time of their initial public offering, they come to the market, they still have many, many innings to grow for long-term strategic investors. I'm talking, we want to have horizons of 7, 10, 20 years is the type of horizon and perspective that I'm talking about here.
Mm-hmm. So it's one thing to have a market for the trader, but another thing that if you're willing to wait for the long term, it probably rewards you in a very rich way that other markets cannot. Can you give us a perspective of some sense of how big those returns could be? That's one. And how long will the investors have to possibly wait for such super returns?
You asked some very, very good questions. So in general, I probably started off looking at short-term trades. You know, I would like something to be successful in 3 weeks, 6 weeks, 6 months. But the reality I've found from many decades now of experience of investing is that the most successful investors aren't the speculators, but rather they take a 10-year or 20-year view of the returns in the market. Now, on specific investments, it is possible to do as high as 10,000%, but I would stress that those are rare and they're also very, very difficult to truly recognize in advance. Or more specifically, what happens is you're seeing that potential in many, many more companies than will actually go on to make it. So the reality is it's very necessary to have a diversified portfolio of these investments and themes. Again, each one you have reason to believe will go on to great success, but in the reality is 1 in 10, 1 in 20 will actually encourage that success over that long period of time.
Mm-hmm. The average retail investor, and you know, typically here we are talking of a lot of people who are watching us, people who are watching us right now and listening to you right now. A lot of them are investors who are venturing out in the US markets, whether it's from the MENA region or from the Indian subcontinent right now, India right now. A lot of them would be ones who would be taking their first baby steps into the US markets. What are some of those points you would suggest they keep in mind so that they can reward their investments, or they can expect the real rewards to happen in a few years' time?
One that I would stress is you want to go with proven strategies. You probably don't want to be the individual stock picker. I found it best to have strategies that follow experts, or again have been proven over not just a year or two, but you really want decades of knowledge for that strategy. And then you want to be diversified. Ideally, you'd like to see at least 20 different investments following a particular strategy. Those are two things that will lead to success. The third thing is we're always fighting our human biases, and the stock market doesn't go up in a straight line. And there will be times in the stock market, in the US stock market, a 50% drop has occurred 5 times in the last 100 years, but that scares out an awful lot of people. And then to make matters worse, they don't know when to get back in. They wait 1 year, 5 years, sometimes 10 years, and they miss a lot of the return and the growth. So it is necessary in this strategy to not just talk about what you're buying, but to know what you're going to do when the stock market falls. Ideally, I think it's been proven over and over again, the answer is you stick with the market. You've already allocated a safe amount of money in the market. You know and have accepted that it's going to go down quite a lot. And even when things look absolutely worse, that it can only get worse from here, that's usually the time that things actually improve. But you want to be holding on so you don't have to face the difficult decision, when do I get back in the market? So those are 3 principles that can help people truly succeed in investing in the markets, particularly in the US market.
John, I'd also like to bring to your attention, there will be the odd question that will be coming in from the audience, people who are attending. So as and when you can suggest, we'll also take some of those questions along. People they'd love to listen to what you think of some of those points that they're trying to raise. So let me know whenever we can ask those questions, and meanwhile we can continue the conversation. And I'd encourage the people to put down your questions in the option there, in the Q&A option that you have, so that we can take some of those questions further ahead. And we'll have a whole variety of questions. You know, QQQ, the ETF, has been so popular that people will have questions about them, and maybe other ETFs as well. So we'll come to that in a little while. Since you raised the issue of you know, people sticking to not be an individual stock picker, how do you address themes that come in? There are times when you'll have, so for example, the world is looking at rebooting itself, as everyone seems to be talking, and green is the theme now. How does one identify a theme which is a long-term theme like that, which could really help create that long-term wealth?
The themes will essentially come to you, interestingly enough, that there are companies that actually, first of all, but please understand that a theme is not something that is just going to last months or, you know, a year. The themes and strategies that work are something that lasts decades. Therefore, in many cases, or most cases, you're actually going to see packaged products, packaged models that go after these particular themes. Mm-hmm. And often, 1 or 2 things happen. You happen to have some knowledge of that particular theme. It touches you. Maybe you're interested in the social and corporate governance, or maybe you're interested in green, clean energy. But also turns out you may be interested in a particular investor or investing style. You're going to find that the leading thinkers and leading firms have actually packaged and put that together for you to make that easy to actually do. You may actually have multiple choices in that way. So it's not so much as having to come up with a theme or recognizing it yourself, but selecting actually from a multitude of choices, of themes that actually appeal to you.
Mhm. Okay. It's very important because, for the average investor, understanding some of these themes and being able to appreciate that something may last longer than maybe 5 or 10 years, or maybe, even if it, something is like 2000, 99, 2000 was the time when the internet boom happened. Some people believe that was over sometime later, but then we're seeing that play out still, and still there is strength being seen in that. How do people differentiate between what could be ephemeral in the wider context, and what could be really the long-term theme?
This is something that has challenged experts for a long time. We have venture capitalists who they, their life and their jobs are to study very, very specific areas to try and make that determination, and then to try and determine the best companies. And what they feel is they get it really, really successful, right, only one time in 10.
Mhm.
So it is virtually impossible for the average retail investor who may have an hour here and there to really study the stock market, let alone a particular stock, to
Mhm.
truly do that. So one of the things that can turn into favor is to look for a trend that is already there. So they want something first, second, third inning, again, using baseball out of a 9 inning session. So they're probably not advised to jump on something extremely early, except if they have some inside information. So if they've used a particular product, they've seen the benefit, they've seen the pain point that it solves for the consumer or business, that in some way gives them a inside edge. One of Peter Lynch's great wisdoms and teaching is the retail investor can get the edge over the professional because he has come in contact with something in particular in his life or his work that he recognizes solves a particular problem and can be widely applicable. So that if there's a way for a retail investor to do it, it would be touching on something he truly knows about, has experienced the pain, or his family has experienced the pain, and therefore sees the benefit of that company's product.
Mhm. Mm. A question which has come, there are quite a few questions coming in. So I'll just read out because you partly spoke about this, but Shaurya has a question. He says, how do we identify companies which are worth investing in, especially the ones which are in the initial stages and have huge potential for growth? You mentioned about the insider information or the customer insight that you may have. Any other points to add to that?
Um, I appreciate his wanting to emphasize on the very, very early stages of growth.
Mhm.
But other than your own gut feeling and then asking around, do other people also share that particular feeling? It is very difficult to do. I'll have to change that. It's much more practical to deal with companies that are already listed and supplying the information on the stock exchanges, whether it's India, Middle East, or in the United States, and then follow more the proven strategies. The question again was from somebody who would like to pick individual stocks that are going to perform. And actually, it sounds like he would like to be an angel investor in a company before the company is even listed on the stock market. Would like to do that. I can tell you that's even more challenging personally to do. It's much more likely to be successful with particular stocks. I hope that answers the question, even though I realize the person who asked the question wanted very, very early stage stocks and what to do about them and recognize them. I'm much more prepared to help him succeed when he talks about the more middle stocks that have now proven that they've got traction such that they're actually on the stock market.
Mhm. But also, you referred to the currency benefits very briefly earlier. Can you give some idea of how big those gains have been specified in a specified period, particularly if you have tracked the way the dollar vis-a-vis the Indian rupee has moved?
Actually, yes, I have a slide that can actually answer that question, I think demonstrate it. Let me see if I can share that with you.
Sure, sure.
What you're seeing here is
Mhm.
the US dollar versus the Indian rupee over the
Mm.
last 10 years. And you're going to see if somebody had put his money in the, even just in a bank account,
Mhm.
um, that it would have appreciated 63% being held in US dollars compared to the Indian rupee. Now, as people who have traded currencies know, it is also not a straight line. There's a lot of volatility. But the important thing to notice is, and the reason I did this over 10 years, there has still been a dramatic trend. And while we don't know exactly what the future will be, the
Mhm.
trend has not stopped right now in this, the dollar versus the rupee.
Mhm.
So somebody investing in the US stock market gets a tailwind. Not only are they potentially getting the performance of the company, but they're also getting this additional benefit of holding their money in dollar denominations.
Mhm. Also, John, while we are talking about the currency, I'll just like to also ask another question to you. The models for US stocks that you've created and built, and can you explain how these are proven strategies based on academic studies? If you can help the investors understand that idea.
Sure. Let me, I guess to make it uh, easier, uh, first, through the alphaniti platform, for the first time, particularly Indian investors can really invest in US stocks.
Mhm.
And alphaniti, in combination with Lydia, is offering three packaged strategies, three themes, three strategies based on academic papers and others that do this. The
Mhm.
first one is actually called the twin momentum strategy. And
Mhm.
let me see if I can share this. There's an awful lot of information packed on
Mhm.
this, but this is based on a academic paper by Dashim Wang and called Twin Momentum. The
Okay.
essence, the insight, the brilliance of this is that it's not just the momentum in the normal sense of the word of the price continually going up, but it also converts the fundamental measures of a company, the performance of the um, uh, assets, the performance of the revenues, performance of sales, performance of cash flow, performance of shareholder yield into a trend and assigns a score in that. And then all the stocks in the market are actually rated by these twin momentums. The one, the momentum of price, the relative strength that is, and second, the momentum of the fundamentals, how good the accounting measures of the company are, and
Mhm.
combine that together. This is uh, basically produced returns that are twice that of momentum alone, and momentum itself has been a pretty good strategy in most years. So that's one example
Okay.
of how we actually implement that. The process is very important. We apply this, and this has always been one of our principles, to all the stocks that have liquidity in the stock market. And there's some 2,600 or so stocks that actually meet that requirement. And then we evaluate each stock one by one. And again, this is why clean data is so important, and
Sure.
come up with a score for each of the stocks, and then take the top 20 of those stocks, put that in the portfolio, and every quarter we go through this process again, and then again putting only the top stocks in the portfolio. So this is one way of doing it. A second strategy is the Mohanram price to book growth strategy. And Mohanram is a professor at University of Toronto, originally at Columbia University when he wrote the study. And he created a score for growth companies. He took what are known as the most expensive companies in the market. And usually that's not a good idea. The really expensive companies have extremely high growth expectations and returns built into them. And more often than not, people are disappointed. But he said, is there a way of separating the wheat from the chaff and understanding how to essentially, what are accounting factors that would truly support the growth of the company? And he came up with 8 different factors assigned a score to each of the stocks. This has been a phenomenal strategy, basically return of 20% per year versus the S&P's 11% per year over the same period of time. And I'll actually share one more strategy. Again, we've packaged this together. And this one is a multi-factor one from Pim van Vliet's book. He's head of investing at Robeco in a European country. And he found that you could actually pick out conservative stocks and that low volatility stocks. You would think that stocks that don't vary so much in their price would actually kind of be very staid and underperform the market. But he found that it was possible to pick stocks with certain characteristics and low volatility, multiple factors, that actually outperform the market over very long periods of time. He actually did his research going back to 1926. And he found that there was a return of 15% per year versus 9% for the market. Now, by the way, I think people should know, it did take me a while, actually many, many years to acquire this knowledge. When comparing returns on stocks, it is possible to talk about hundreds of percent when you're talking in weeks or months. And again, when I first started out in investing, I thought those are the stocks that I should arrange for. When we're talking really long periods of time, 20 years, 50 years, 100 years, the returns go down that you're actually seeing. So these are still exciting and really good returns, and even 1% makes a difference when compounded over 20 years or 50 years. So somebody seeing this should not be turned off by a 50% compounded return. That would be absolutely marvelous for any investor to accomplish over a long period of time in their investing history. So those are 3 ways that we truly implement themes, particularly based on the insights of some of the best academic papers and books.
While you've been referring to some of these ideas, there have been quite a few questions coming in, John, and with your permission, if I can just seek answers to them, particularly because there are quite a few questions on the ETFs, and people have named and they want names of ETFs. I'll not request you for names, but some of these ETFs, because they're so popular, and I named 1 or 2 of them, Spider, which one of the oldest ETFs around, QQQ, which is doing very well lately, and that's why I grabbed the attention. What factors do people keep in mind when choosing a particular theme around an ETF? Can you give them a sense? Because ETFs are so popular that everyone wants a piece of the action.
Sure. The vast majority of the ETFs are index funds. So even the ones that you happen to mention represent some of the big index of the United States. Honestly, that's not a bad way for an investor who does not have much time to spend to invest in the market. They're sharing in the good and bad that happen in particular markets. In general, it's easy to invest in multiple indices at the same time. So they
Mhm.
really don't even have to choose like between the SPDR, which is the S&P 500, or the QQQ, which is the NASDAQ listed stocks. And the vast majority of ETFs are simply variations of that. There's been more sophistication, and this comes from academic research, that factors, there are ways of tilting those indices to make them have better performance over longer periods of time. That
Mhm.
does require more research to understand. They go by different names, beta, smart beta. Um, the other alternative way um, is not investing in one ETF. But again, the alternative is when you can have a model such as the one that we propose that holds 20 stocks that is based on a theme that has been shown to, in the past, outperform the market is the other smart way of doing that. So an ETF is one version. Somebody I think that wants to have a better chance of outperforming will use some of these more modern portfolios and tools and use the individual stocks.
Mhm. Also, because people want very, uh, or should I say, better understanding of some of the ETFs which are very sector specific, whether it's a biotech. And, biotech companies lately have been the toast of the market in these days, because every pharma stroke biotech company wants to list, even the big ones or the smaller ones. The ones that are listed have done very well, or even in the related, the biosciences area. How do they go about, and there's a last question about the specific sectors, how do they go about choosing or separating the wheat from the chaff?
The vast majority of them, maybe almost 98% of the ones that specialize in really tiny niches or sectors, don't separate the wheat from the chaff. It is very, very simple. They will look at the market cap of the particular firm and they will select, let's say, the top 100, top 200, or top 300 by
Mhm.
market cap. So
Mhm.
they're trying to put in all of the particular firms.
Mhm.
Almost none that I'm familiar with that become an ETF try to apply or use judgment in terms of picking out which will become the winners. You
Mhm.
almost always they're just uh, dumb, non-intelligent, index-based rules that just tries to have everything weighted according to the size of the company.
Mm. But there are also some very interesting questions related to not quite the markets, but how it could impact the markets. So if Joe Biden wins the presidential election, there's a big if there, could corporate America bid goodbye to the tax cuts that have been seen in the Trump era? Because that could directly hit the bottom line of companies. How are you seeing it?
Regardless, yes, regardless of who wins the election for the presidency, taxes in the US are going to go up. There was no choice once COVID hit. Our government, one of the reasons the stock market is doing so well right now is our government has released a few $1 trillion of support. That will eventually have to be repaid back. And the only way that's going to happen is taxes. Um,
Mhm.
Other than that, some other wisdom is that, believe it or not, it used to be felt that when Republicans win, that was very good for the stock market. But it's now been proved here historically that for whatever reason, the stock market has done better under Democratic presidents than under Republican presidents. This last one has actually been a exception, but he was able to get in sort of at the bottom of a market. So in some ways, that timing was handed to him. So again, tax cuts. Uh, People know that it's already going to happen. Not tax cuts, but tax increases are going to happen regardless if it becomes elected the president. Other than that, it has not been shown that the president truly affects the stock market any more than any other factor. A lot of people would like to believe that, but and many times media will assign the effect of the movement of the stock market to which party is in power. But in truth, that's not really driving the market. The market is going up or down for lots of other different reasons, not for the politics in the United States.
Also, there's another question that's coming in, and with that if factor, could it also mean that the size of the Fed balance sheet could be reduced in the early part if Joe Biden becomes the president, and how could it impact the markets? Lesser liquidity logically would mean markets would cool off a little bit.
Joe Biden's, whichever president, is going to have a hard time reducing the balance sheet. It is possible either president may decide to start trimming or having less reinvestment, less fiscal spending. But honestly, you're probably more likely to see that at our state and local levels, which doesn't have the ability to print money like our Federal Reserve Bank does. So again, I do not attribute this to Biden either way. We're still going to be seeing increases for quite a while. We're not over COVID yet. As of the last couple of days, we're now at an even higher peak than we were at any point. So we're not out of the woods yet.
And there is another very interesting question. Why can't we simply copy the investment? Of course, it's an investor view. Simply copy the investment pattern of Berkshire Hathaway and other top investment firm in the proposition in proportion of the amount we are ready to invest in the markets. Is it as simple as it appears to be?
No. First of all strategies do come in and out, and I have a lot of respect for Warren Buffett and Berkshire Hathaway. He's been one of the most successful investors in the U.S. stock market. There are a couple of different things that go into this. One is not all of this portfolio are public stocks that can essentially be picked. Second is you're going to be following him by maybe about a 3-month lag if you do that. So you're losing some of your edge. He's either going to be in stocks before you or out of stocks before you. And the third really important thing about the Berkshire Hathaway portfolio is he can only invest in elephant-sized companies right now. And investing in even moderate-sized companies simply doesn't move the needle because his portfolio is actually so big. So if you want some of the medium and smaller-sized companies that are actually going to be showing the bigger growth, they've got more room to grow, he can't do that. So you're not going to find that by copying his portfolio.
Also, there are, I mean, we've had quite a few questions come in, so I'll just take some of those questions that are coming in as well. Some people also want to understand, they want sectors, if you could name where they can see the big growth happening. So I see some in the timeline for the questions, I can see some of those. So can you probably name sectors where people should identify? Is tech so hot, but it's also run up? What could be next?
Well, biotechnology and medical are still, they have been hot and are still going to be hot and can still show a lot of growth. It's also very difficult to truly predict which of the pharmaceuticals and the inventions are going to become winners. They're going to survive the trials, become FDA selected, and then go on to become winners. So that's one. Second, interestingly enough, has to do with sectors that are out of favor. So energy, as an example, is tremendously out of favor right now. So is travel. So to the extent that you are a contrarian and like that style of investing, there are potentially some big opportunities. Again, in the long run, we don't know exactly when these are going to turn around. but that represents tremendous opportunities just because they've been hit so bad and so hard and the expectations are so dismal.
Mm. If I can take one more question from the audience. This is coming from a gentleman called S. Vijay Kumar from a place in India called Hyderabad. And his question is the facility of what we call in India SIP, or the Systematic Investment Plan, available for mutual funds in the US?
I'm sorry, I have to profess, I'm not, I don't know the answer to that question.
Okay, no worries, no worries. Since it was an investor question, I thought I will also ask.
But I know that, again, since particularly for Indian retail investors, they've really been unable to invest in any meaningful way in the US stock market before. I doubt that that is actually available.
Okay, point taken, point taken. Some people have been worried, people who are listening, they have expressed their question, they have expressed their concern. How long will this liquidity-driven rally last? We've seen the 2010 era, post the great financial meltdown, where the markets were pushed up, and last 10 years have been superb. Can we expect a similar rally given that the markets are awash in liquidity?
Wow, that's a really good question. And the truth is, we don't know. I don't know if it can last. The government is really committed to funding and to keeping a number of Americans whole and keeping businesses in operation. And some experts feel that's going to call for another $1 to $3 trillion. So far, there's been a willingness, and honestly, I think even when Biden becomes president, he will want to do the same thing to protect Americans and American businesses. So this could still go on for quite a while. I don't see any reason to believe that it's stopping shortly or stopping at the end of this year. But the truth is, we don't know, and we also don't know in terms of the public and traders' reactions to it. When do they lose confidence in this? I've been shocked and surprised that, frankly, the most sophisticated investors expected our U.S. stock market to be down for much, much longer than it actually has been. This has been one of the quickest recoveries on record. So there's a surprising belief in the U.S. government and the U.S. economy and entrepreneurs to keep this going. And I guess that's always been part of the American success factor, that is there. So we have a lot of people that are still believing in that. Warren Buffett certainly has mentioned that many times for the extremely long term, that he would not bet against the American ingenuity and American businesses. So even when the stock market goes down a lot, he's been right. It's still been worthwhile investing. I hope that answers the questions.
Okay, one related question. We've seen the markets rebound. I mean, from that March end low that we're talking about. Have investors missed an opportunity to get into maybe the industrials, particularly because a smart recovery, a growth in the industrials could reward investors in a pretty rich way?
So that's another intelligent question, but I'm going to say the answer depends upon the time frame perspective of the individual. That individual probably missed the contrarian opportunity to invest when things were looking extremely, extremely pessimistic and the market was down. But from a long-term investment, we just completed a small study that looked at what would happen if an investor over the last approximately 80 years invested at the absolute peak of the market each time, not at the absolute bottom where you get the returns, but at the absolute peak. So you would think that would be the very worst time to do. So it's a time just like now. And we found that the return was more than, I think it was like 80,000%. It was an amazing return just by being in the stock market, even investing in the worst periods of time, and even looking at the end of the performance, like in March, not now when it's recovered, but even in March. So if your time frame perspective is long enough, 20, 40, 50 years, which I would argue is the smarter way of investing, there's still plenty of room for growth in the American market, including in the industrial sector, which has recovered.
And last question from you. So themes, follow the themes and make sure you're there for the long term. Would that be sum up your message to the investors?
Yes, I actually think that was a pretty good summary. Thank you for whoever said that. And it sounds like that person was really listening very closely.
Okay, thank you so much for being with us and sharing your insight and your experience of over 2.5 decades of being in the US markets. And there have been quite a few questions, and some thankfully you've been able to answer. Really grateful for that.
Thank you.
Okay, we'll also go across to Tahir because there are a few questions also for Tahir that have come in. And Tahir, if you can take some of these questions.
Sure, absolutely.
Would you like to add to what John mentioned about investing in new ideas and how it can help investors in the Middle East and North America, the region that you really know so well, the MENA region?
So great. So actually, I had planned quite a few slides around it. So I think the amount of question the audience asked, I think John has really summed up really well. But how I like to just share one single point. Let me just share my slide. You just give me a second.
Sure.
Yeah, if you can see this. Yeah. This anyway, pretty much John has covered this point. Now US market cap itself is around 54% this year. So one, if somebody is not investing here, that means they're really missing out some great opportunity here.
Sure.
So the next slide, I like to focus here around the themes, what people are talking about. Through my research, I've just got about close to 10 to 12 I've listed down. The amount of research, the amount of disruption and innovation which has happened over the years and now, and it's going to happen. So if you lead to all this and if you trace back, either these innovation and invention are happening either in the US or these companies are registered in the US. So it again, emphasize what John was saying, that if your perspective is long-term, there are a lot of innovations and a lot of companies are doing well and would continue to do well. Just to take one example, like if you take streaming media, so traditionally, if you see either the companies own the distribution or the content, if you suddenly see the disruption which is happening in the space, like companies like Amazon and Netflix, now they have together, they own distribution and the content. So for instance, let's say today they launch a product, they just have a next minute the entire world is the market. That's the kind of disruption which is happening. So similarly, John emphasized on the biotech and pharmaceutical companies. One of the interesting things I'm tracking is the DNA, next generation DNA sequencing itself. So my belief is that going forward, even the disease can be cured at a DNA level itself. You may not need so many medicines. That's the kind of disruption is happening. Another one thing to watch out, another one theme would be watch out is 5G technologies. Just as we think now that iPhone era is over, for all you know, by the end of the year when 5G technology emerges and iPhone could be suddenly one more big thing, those smartphones can itself become a medical device in our hands. So which means, what does it mean about that is iPhones about close to 200 to 300 million handsets could be available for a replacement. That's the next growth, what iPhone alone would look at it. So to sum up, there are a lot of good themes. There is a lot of disruption happening. It's a great point. What would one benefit is that by participating in this economy, you would get to participate and get the gains out of this company early in the stage. That's one thing. A last point I would like to highlight is what would thematic investment do, what John was referring to about the three. One example is, let's say in a financial service sector, if you had to pick up some stocks, you would traditionally go and pick up some good companies, nothing bad at all. But if you look at last 5 years, the kind of returns they've delivered. And now if you see my next slide, what would thematic investment do is within the same financial service industry, it would pick up a different set of stocks. And if you see the same time period, the kind of return this has delivered over 300, 400, 500%. So that's the advantage what John is talking about, what a thematic portfolio would do and quarterly rebalancing will bring up to, that's one. Another example, I can go on and using many examples. I would like to use just last example is, let's say in automobile industries, if you see a GM and a Ford, nothing bad at all with these companies. They have consistently delivered certain returns, double-digit returns. But what would thematic investment do is it will pick up companies like Tesla would have given like 200, 300% kind of returns over the same period of time. So similarly, what John was referring to is there are good models and good strategies to follow. If you stick around with them and be smart, there is a lot of gains to be made. And not to forget the amount of themes which I articulated in my previous slide, people can really benefit from it. Yeah.
Okay, that sounds very interesting, Tahir. I'll just see if there are any more questions.
Yeah.
Okay, people are worried about some of the losses made in a volatile market. Well, that's part of the game, I'd imagine, and not many more on different topics coming. So that's, we've seen that slide, Tahir, if you can.
Yeah, sure. I'm just looking.
Yeah, no worries. Just one last question to you, Tahir, if you can explain, for the average investor, whether it's in the Middle East or India or any other part of the world, it's very important that they understand the way SEC works and how they work towards investor protection. Ultimately, that gives the average investor the confidence that they can go ahead and invest in the markets. Somebody is watching. What are some of those measures that the SEC takes so that investors are protected against a whole variety of things that could go wrong?
Sure. So unlike any other financial institution, even all these financial institutions around the world are highly regulated. Like John mentioned, US is an extremely regulated market. They're very serious about investor protection. That's the prime focus there. So just to give you a heads up that our broker partner, DriveWealth, which is SEC FINRA regulated, which if you come in comparison to India, it's like SEBI of India, or in the Middle East, it's like central banks. That's how it is protected. Second, all the assets of customers, the custodian is Citibank. That's the structure regulator allows it to follow. So there has to be a custodian to hold the assets. The third also is our partner is a SIPC member, so which essentially means, again, it's a governing and a protection body which allows and which provides up to $500,000 of insurance, even in cash, $250,000 in cash and $250,000 in stock holding, which essentially means you have 3 levels of protection. Even if any of these companies in the value chain goes down, so your money is safe. That's the whole thing I want to mention. Yeah.
John, would you like to add anything to that?
I thought he gave a very good summary of the protections that are indeed built in. It was multiple levels. It was the fact that, again, that there is a custodian that is separate from the broker or financial planner that actually does hold the money, and therefore they've got rules and regulations for getting it back to the end client in the event of any kind of failure, plus the extreme rules and regulations that we do face. So I thought you gave a very, very good summary, including again, like the SIPC protections for the balances that are in the accounts. And by the way, a number of brokerage firms take on additional assurance on top of that as well for even bigger accounts.
Mhm. Okay, gentlemen, looks like we've run out of time completely. Thank you so much, John and Tahir, for taking out the time. John, for your insight, and Tahir, for your understanding of the MENA region and explaining it for the investors. We're really grateful. And there have been so many questions. Unfortunately, we've not been able to take all of them very specifically, but I've tried to take and kind of sum it up for John and Tahir. Thank you so much from the bottom of my heart to take out the time for this very special conversation with you guys.
Thank you,
Thank you.
Ashutosh. It's wonderful, and thanks to the audience. I think a lot of patience you have shown and great answers. And I would love to thank John on behalf of Stockal. It was an outstanding session, and we promise to bring you back again.
Thank you so very much. Be happy to come.
Thank you.
Okay, thank you so much,
Thank you,
gentlemen. Okay.
Ashutosh. Great.
Time to wrap up, and just let you know also that in our effort to explain the opportunities that are there in investing in the US markets, we'll try and get you more on this series. You'll hear from a lot of experts, you'll hear a lot of ideas, and of course we'll answer your questions every time we're there with you to bring you all the options that are available with you. And of course, the best idea is, or the best thing is, that we'll try and take as many questions. Some of those questions which have not been answered right now for you, we'll try and get back to you offline so that they are at least answered a little later. Thanks for connecting with us, and have a wonderful time.
Thank you.